Right. So everyone, welcome to the FFEM session for today. There might be some other people joining us as we go through, so I will let them in. Today we are joined by Rebecca and Stacey from Sarah Stacey, sorry, from Dimensional, and they've been very kind to agree to come and talk to us today in the group and agree to the recording so that I can share it with everyone afterwards. There's just a few things I'm going to talk through their bios for you as well, but also just a couple of housekeeping things just at the start. The group that we've set up is on LinkedIn. I am also trying to think about how I can sort of spread that community a bit further or make it a bit more practical for everyone, because not everyone uses LinkedIn that much. So I'm going to I've set up a WhatsApp group for a community there that I've put the link on the group today if you would like to join. And also I'm going to look at somehow thinking about a website so that I can make everything a bit clearer for everyone about what the aim is of the group and what our mission statement is. So without further ado, though, I will hand over to the ladies at Dimensional. So Rebecca Bilicci is Vice President, Regional Director and Manager at Dimensional's Global Client Group, where she leads the client support functions in the UK, manages strategic relationships with organisations and develops new business with more complicated IFA firms. And she's also responsible for launching and spearheading the EMEA Women in Wealth and Wealth community within Dimensional. And I've really enjoyed talking about how she can share her thoughts with us today and understanding more about that community as we've had our discussions. And she's joined by Sarah Stacey, who is a Senior Associate at Dimensional in the Global Client Group, supporting UK and German advisors across investments, communication and business strategy. Now, welcome ladies, and thank you for being here. When we originally spoke about what to talk about, we did sort of came on this topic because we felt that it was still quite prevalent and important to talk about, and I'm really looking forward to you sharing your thoughts with us. So I'll hand over to you and you can get going.
Amazing. Thank you so much, Gretchen, for that kind introduction. As Gretchen just mentioned, my name is Rebecca Bilicci. I'm a manager, a regional director and vice president. I know it's a bit of a mouthful at Dimensional. And I'm also responsible for spearheading this EMEA Women in Wealth community, which is a community for our clients. And it is all centered around improving the investment experience for women. I'm also joined by Sarah today, and actually I'm going to pass it over to you, Sarah, to let you introduce yourself very briefly.
Thank you. And yeah, good morning, everyone from my side. As Gretchen already mentioned, my name is Sarah Stacey, and I'm also part of the Global Client Group here at Dimensional. I'm a Senior Associate, and Gretchen's mentioned this. I work with financial advisors and planners just like yourself across EMEA, so also working with German and UK clients, and really across investments, business strategy, and communications, which will be one of our focus areas today.
Yes, it's all about communications today. But let's start off by introducing you to Dimensional, if you're not already aware of Dimensional. We are a $600 billion systematic asset manager. The assets that we manage represent more than just those shares in a portfolio. The money represents the savings, sacrifice, and dreams that investors have entrusted to us, and we take this responsibility seriously. When it comes to working with advisors such as yourselves, I think we have a really unique way of working with you. We call this our 360 client experience, where we engage around investment topics, as well as provide you support around business strategy and communication. So as Sarah mentioned, this is why we're here today, to talk to you about the recent market volatility and how you can effectively communicate and emotionally settle your clients. So let's focus our attention to last year. Here is the growth of investing $1 in the global equity market. That's the MSCI All Country World Index. And by the way, I'm going to continue using this particular representation of the global equity markets in the next couple of slides. So just bear that in mind. And what we're looking at is investing that $1 in 2022 in these broad global equity markets. And what you can probably see is that we would have lost money. In fact, we would have lost about 20 cents of that dollar. So your value of your portfolio would have decreased by about 18%. And not only were global equity markets down last year, we were also hit with fixed income having one of the worst years in history. Together, this really surprised many people. Prices rose for many of the things that we needed to buy. Interest rates were rising, making it confusing for people to consider buying or selling a house or making other major financial decisions. And on top of all of this, 2022 also presented us with those ongoing anxieties that we had about the COVID pandemic. All the volatility and uncertainty, I'm sure that many of your clients felt nervous, uneasy, and perhaps understandably quite worried. And their investment philosophy, which may have accompanied them for many years without any issue, was now being put to the test. I'm sure that many of you are going to resonate that you often had to have very difficult conversations with your clients, where you had been looking to help them stay on track during these uncertain times, but for them, it was near impossible to remain rational. And that's really precisely why investors need you, a financial advisor, to guide them through this. But what we need to remember is that 1 year is an incredibly short time period when it comes to investing. And really the best chance for success is encouraging that long-term investment philosophy. So let's take a look at a slightly longer time period and what would have happened if we invested in the global market over the past, let's say, 10 years. Now see is that other than the recent market volatility, markets have actually had a relatively smooth ride, at least globally. Some comfortable years for being that global equity investor. And despite the uncomfortable experience recently, during this 10-year period, that $1 investment would increase to just over £2. So about just over 8% annually, or on a cumulative basis, about 132%. But now let's take an even longer term view. So I'm going to pull the data back all the way to 1988. See here is that despite the inherent uncertainty associated with investing, if we stayed in our seat, our $1 investment would have grown to just over $13. So that's about 1,247% cumulatively, or about 7 to 8% on an annual basis. This is why it's important for investors to remember that in order to achieve higher returns, we, as investors, need to be able to withstand these market swings. So with the past year now over, we can reflect. What have we learned? And most importantly, what can investors learn? And that leads us into the theme for today: how to remind your clients of those well-known principles of a successful investment experience, how to keep calm when markets are volatile. And the 3 topics we have picked to best address this are: how to deal with the crisis of the day, how to deal with the emotions of market volatility, and how to reiterate the value of your advice. One of the frameworks we're going to introduce you to today is this 4S framework for effective client communication. This framework helps to personalize client conversations and make them more impactful by using the 4S elements: scripts, stories, sketches, and supplements. The idea is that with the very limited time we have speaking with clients, and knowing that there are many different ways that we learn, such as by hearing, by what we see, and also in some cases by how we interact, so that kinesthetic learning, we want to make sure We are most effective when it comes to communicating complex topics, which we deal with when it comes to financial markets. Today, we're going to combine all of these elements to help underpin those 3 topics that I mentioned. So with that, Sarah, should we start with our first topic, the crisis of the day? As we know, it's very tempting as an investor to follow the media headlines and read into those headlines and possibly get a little carried away at times. What if I, as an investor, Sarah, asked you the following question after the market decline that we've recently experienced? Should I sell out of my portfolio, Sarah? It has lost so much of its value and I really can't take it anymore. Sarah, how would you respond to this question?
Yeah, thanks, Becca. That's a great question. And maybe it's a question that you all have gotten, particularly looking back at the last year when talking to your clients. And it's really helpful when we have these recurring questions that come up again and again to maybe start off with a script that we can use as a foundation to then build on and really hit on those important aspects that we want to bring across in an answer. So Becca, with that in mind, and having heard your question, what I would answer is that, of course, markets fluctuate every single day in response to news. And unfortunately, that can, of course, lead to market declines in the course of that and triggers fear and concern with you, but also other investors. But we need to remember that when you exit the market, the phase after the exit, when you wait for the recovery phase to begin, can actually be just as nerve-wracking, because what we're doing is we're replacing that stress that you feel because you're invested in the market with that stress that you're currently not invested in the market. And what we see in addition to that is that there's actually the decision when you start to invest again that comes often after the markets have already begun their recovery phase and leads to missed opportunities for you as an investor. So shifting your portfolio frequently in response to those news and those headlines that we hear brings actually unnecessary stress for you as an investor and leads also to a poor investment experience overall. Now, what I've just illustrated, we can see now on this page as well. It's a little script. But of course, as you read through this, the important aspect is that we want to make those scripts our own and really kind of tailor it to the conversations that we have with our clients, of course, to respond to those questions that they may have. Now, a great way to also maybe answer the question slightly differently is to actually draw some parallels to another part of life or to use a little story or anecdote. And there's a great one that we can actually use when we think about market volatility, because we can compare the experience we have when markets are volatile with the experience we might have when we go on a roller coaster ride. Because if we think about a roller coaster ride, it's probably naturally associated with a lot of ups and downs, twists and turns as we go. And we're probably all familiar with those uncomfortable times when it's maybe getting a bit dangerous. So our intuition is, of course, during the roller coaster ride, not just to get up and climb out, because that would be incredibly dangerous. But what we do instead is, of course, we buckle up, we sit tight, and we wait until that roller coaster ride is over. And the same actually applies to the stock market, because if we're experiencing fluctuations just like we have in the last year, we should rather tighten our seatbelt, take a deep breath, and not react and let our emotions guide our judgment. Even in the moment, it doesn't feel logical or rational to do nothing. And again, what we have here is that little script or that little story that I just presented. And it's, of course, some things to highlight is that we want to make sure that we use easy to understand words, simple words that people can really connect with. Now, at this point, what I would like to do is actually share a little sketch with you, because one of the 4 S's is also sketching, and it's a great way to illustrate one important point when it comes to market volatility, and especially the stress that is associated with it. So for this little sketch, I would like you all to imagine that you are investors and you have the choice to invest in one of 3 portfolios. So we have portfolio A, and the returns look something like this. We have portfolio B with returns that look something like this, and then portfolio C here on the right with returns that look like this. Now, just looking into the room here, what would be your portfolio that you would choose most likely? I think I can take us. lucky guess. Yeah, I think we all probably wouldn't hesitate to say, well, of course, Portfolio C is my top choice because I have the best returns. However, there's a catch, because what we're looking at aren't different portfolios, but it's actually the exact same portfolio. But I'm looking at this portfolio over different time frames. Now with Portfolio A, I have an investor that takes a look at their portfolio every single day. And as we know, markets go up, they can go down every single day. So it's kind of a mixed ride, most likely down probably. Now, in the middle, I have an investor, a bit more disciplined, but still takes a look at their portfolio every single month. And again, that can be a mixed picture. But on the right-hand side, we have an investor that's quite disciplined and really just takes a look at their portfolio once a year or even over the entire investment time frame. And we can see by this simple example, by this anecdote or sketch, that it really kind of impacts my investment experience. And we've heard it from Becca at the beginning, to put it in a bit more tangible way, that when we look at the global equity markets, for example, it really makes a difference. If I look at it from a 1-year time horizon, 10-year time horizon, or over the entire time frame. Now, I want to take this sketch one step further and just think about what would happen if I quantify that amount of stress that I put myself through, given those different time frames, because we would probably all assume that we feel happy and optimistic when we see positive returns. However, we probably feel stressed and pessimistic, maybe even a certain sense of pain when we see those negative returns. So what would happen now if I totaled up all those negative time frames that I experience, those stressful and those painful moments? And for that purpose, let's take a look at a different index. So now looking at the S&P 500 index. So that looks at the largest US companies in the equity space. And we have a time frame that is from 1980 all the way to 2019. So it gives us a nice long time frame of 40 years. And just to remind ourselves, we said we'd feel happy, optimistic, we see positive returns, but then we feel pessimistic, stressful, and a sense of pain when we see those negative returns. Now, if we start with Portfolio A, so that investor that takes a look at their portfolio every single day, and we total up all those negative days over those 40 years, what I would end up with is an investor that experiences 19 years of pain, stress, and feeling pessimistic. And put another way, that's actually almost half of my entire investment period. What about that investor that invests in Portfolio B, so looks at their portfolio only every single month? Totaling up that time would lead us to 14 years, a little bit less, but still, if I total up that time, still a third of my investment horizon, that I have a painful and stressful investment experience. Now, what about Portfolio C? So that investor that really is quite disciplined, just takes a look at their portfolio once a year over that 40-year time frame. Well, totaling up that entire time, we would end up with just 7 years stress and a sense of pain. And that's just 1/5 of my entire investment time frame. And I also always like to look at it slightly differently, because on the flip side, that means what I'm left with is actually 33 years the joyful and stress-free investment experience. So I think this is a really nice sketch, that longer sketch with those portfolios and then that time frame, to illustrate that it's really in my own hands as investor, how much pain I put myself through. And Becca, I think that highlights nicely that discipline and that long time frame is actually quite important when investing.
Thank you. And as Sarah mentioned, a portfolio's value will change daily. Sometimes it's going to go up, sometimes it's going to go down. However, these movements are beyond our control. And as an example of one of those other S's, so the supplement piece, that's the 4th S in the framework, let me share with you a couple of really powerful images and graphs that we published last year for our clients that they're able to share directly with their clients. And these images really underpin this concept. So if you currently work with us as a client, you'll be able to get these images by logging into our secure client website, and you can download these. Or better yet, you might want to just reach out to your regional director. Let's have a look at what this supplement looks like. What you're seeing here is an example, again, of the US market. And really, by the way, we utilize the US market for a lot of our examples, as it's a really large and robust data set and one that people really do anchor to. And what we can see is that out of the 20 years, 17 of those years had a positive annual premium. So if we're looking at this particular image, those annual years are represented by those columns, and those positive years are going to be that light blue teal kind of color that we see there in those bars. So with 17 out of the 20 years had positive annual returns, even though within those years, there have been extremely negative daily returns. And those negative daily returns are being represented by those red dots there. It might be a bit small for you to see on your screen, but again, if you wanted to get a bit closer to this, this particular data set, please feel free to reach out to us afterwards. What this image shows you is that just because you're going to see or you're going to experience a negative daily return, do not think that this is going to mean that your yearly return is going to be negative.
Yeah, I think that's a really great example, Becca, because showing some of those powerful graphs can really bring those points a little bit more in a visual way across. Well, thinking back to last year again, the potential for recession was maybe something that captured many people's minds, investors alike, and potentially is still a worry this year. So Becca, with that in mind, how would you respond to a question along the lines of this? I'm really worried about a recession and concerned about what happens if I invest at the peak and then immediately afterwards a recession hits. Doesn't that mean that all my money is all of a sudden lost and I'm not even able to make it back again?
A really great question, Sarah, because this is probably one of the questions that I get from my friends and family, knowing that I work in an asset management firm. So I'm going to do my best to help you think about how you could answer that, because when it comes to recessions and market turbulence, this is going to bring a huge amount of anxiety. Any kind of uncertainty is going to foster anxiety. However, what we do have here is the opportunity and the chance to remind investors about the forward-looking nature of markets. And what we're going to do is actually use an example for what we've experienced with previous recessions. So what we're looking at here is what's happened over the last century, again in the US, where there have been 15 US recessions. And in 11 of those recessions, what we actually saw were positive stock returns, so positive equity market returns in the US just 2 years after that recession started. So what we're actually learning from this is that over the years, it's going to really pay to be disciplined and to look beyond those daily headlines. Well, in the interest of time, let's move on to the next topic. And we've touched upon this topic already, and that is the topic of stock market conditions. So, investors might believe that the stock market's current level is going to offer insight into its future direction. For example, when the market hits an all-time high, they may think it has peaked and therefore is likely to reverse. And if the market is declining, they might wonder how much further is it going to decline before the recovery phase is going to begin. Investment decisions based on the market's current level of recent performance is actually what we call market timing. And this approach may lead to potential problems. Sarah, I'm going to put this question over to you again. how would you answer the following question? There is so much volatility in today's market. Should I just wait to invest my money?
Yeah, again, a great question, because I think especially looking back to last year, maybe one that you may have encountered in some of your conversations with clients. So I think, again, a great starting point is to really have a little script that we can use as a foundation to then really kind of address these different concerns that might be related to that. So Becca, again, if you would ask me that question as a hypothetical client, I would say that, of course, by keeping all of your money or some of your money in cash, as you're suggesting, you're actually not just removing the downside risk that is associated with investing, but there's actually an opportunity cost. And one of the costs is that you're actually eliminating your upside potential, because by investing in the market, that is kind of the upside potential that you're giving up. The other risk is, of course, that you're taking on inflation risk.
Very important to think about now.
Exactly. So that's maybe on many people's minds. So having that in mind is something important to remember. Because if we think about the stock market, it's actually continuously priced to offer us that positively expected return every single day, every single month, and every single year. And when there's no consistent way, as we know, to predict when the realized performance is actually going to be positive or negative, actually every day the market is expected to have a return that exceeds that expected return that you would get on cash. So unless, again, someone can perfectly time when to be in or out of the market, investors will have a higher expected return simply by staying invested rather than moving it into cash. Now, we can also take a look at history, and that shows us that those market advances are actually more frequent, that they last longer, and they also have a greater magnitude than market declines do. And again, taking a look at history, it also shows us that markets hitting new highs or experiencing new lows, that actually there's little evidence about what will happen in the future. So what does that mean for you? Well, it actually means the best time to invest into the market is always today, regardless of what markets may currently look like. And we can see that little script kind of here unfolding on the slide. It's quite a large script, so please take a look at it. What we wanted to highlight in that script is, of course, that, again, there are certain important aspects you may want to remember, those opportunity costs that we mentioned. But then I think there's also a very important concept here that we hit on. How important it is to remain invested and really not to try to time the markets as we may be tempted to do. And I know, Becca, that you have actually a great way to bring this to life with a story as well.
Well, I'll certainly try, Sarah, because when investors ask, is now a good time to invest in the market? What they're actually asking is for a signal to time the markets. And they may not actually even realize that this is what they're asking. Walking clients through an example or an analogy of a different area of life may actually help highlight the difficulty of what they're asking us to do. I'm going to use the scenario of attending a sporting event. Not that I've attended a huge amount of sporting events, but I certainly did take the opportunity to dip into the World Cup recently. And I'm sure we have all been in that situation, well, at least I have, where we're watching a game and nothing really has happened. So I just think I'm just going to pop to that bar and get myself another drink or get myself a bite to eat. And the moment you do, something happens. But you're not in the seat, you're not in front of the TV, you're not watching the screen, and you weren't able to see it. A goal, a foul, a penalty, and you were the only one that missed out on the action. I'm just clicking through the slides. Well, we can draw a parallel to investing here, because much of that long-term return in markets is driven just by a handful of really strong days. And similar to the scoring in a football match or any other sporting match, really, we can't really predict when those days are when those days are going to come. If you're not in your seat for the entire match, you might miss out on those important few memorable moments. And if you're not in the market when those important, really strong days return, it can really impact your overall long-run return. But unfortunately, we can't tell you when that's going to be. because the future is uncertain and we're not fortune tellers. So really the best thing is to stay seated and stay disciplined and make sure that you capture the returns that you, as the investor, are entitled to receive from the market. Missing those valuable seconds in a match or missing those valuable few days with investing can have a huge impact. And we actually looked again at the US market data to see what that said there. So again, another example of a supplement that we produce. What we're able to see on this slide is the S&P 500 index from 1970 to 2020. Here in that darker blue teal bar is the return of $1,000 invested in 1970, which amounts to about $121,000 over that time frame. In the light green, we see what happens when we miss out some of the best performing days. So if we missed out the 5 best days over roughly this 50-year time horizon, we see the value of our investment reduced by around $44,000. And if we miss only the 25 best days, it reduces by $94,000. Because missing only a few days, because of market timing, can be costly, it's really important to make sure that you stay disciplined and you keep that long-term view on investing. This really nicely brings us into our third and final principle of today, which brings all of this together in your role as an advisor, and that is the value of your advice. So, Sarah, why don't I ask you a question? Let's say if you were an advisor, which I know you're not, but let's say you were, how would you answer this question? Why should I hire you as an advisor?
Yeah. Well, thanks, Becca. Again, a good question, because I think this one, maybe it came up in the last year, of course, but it's maybe a question that comes up every now and then in different scenarios and different types of conversations that you're having. So again, a script is a great starting point to really address this and tackle this question. So Becca, my hypothetical client in this case, if you were to ask me about the value of advice, I would firstly say that, well, of course, many emotions stem from matters involving money. But a financial advisor can actually combine that deep understanding of your financial situation, your personal goals, with that ability to really remain objective when times get tough in particular. Because this balanced perspective can encourage clients like yourself to make those rational investment decisions. And often that means keeping investors like yourself focused on the long term, tuning out that noise of distractions from the media or from people that we speak to that will take us off course. Because the reality is that every investor actually has a unique financial journey, and helping investors feel positive about their financial position as they move towards achieving their goals that they have can actually be a huge value add that financial advice can provide. And yeah, maybe also reiterating that it's hard to put a price tag on that peace of mind is something to be remembered. Now, again, what we want to share at this point is maybe a little anecdote, a little story that can be helpful to illustrate this as well. And again, want to turn to the realm of sports for this one. So just imagining that a lot of successful professional athletes in the world that we see, many of them work with a coach. Why do they work with a coach? Well, it's really that coach that provides them with that objective point of view, keeps the athlete disciplined, and really helps them to keep up to date on the technique that they're using, is always looking out for ways to improve the athlete, wants to develop that level of trust that then ultimately guides them to reaching their goals. And hiring an advisor is actually a lot like that example, because although you may be able to do everything yourself, you can actually benefit from a professional's knowledge, their experience, their attention to detail that they bring. And in that process, also, you gain valuable time because you can spend that on higher priority activities like meeting with your friends and family or engaging in the hobbies you have. So working with an advisor can also make you more knowledgeable as an investor, which then really helps you on that investment journey, that's more transparent and ultimately less stressful for you. Again, like we've done here throughout the presentation today, we've provided that little script And I think this is a really nice way to actually use it as a foundation, but then really make it personal to your specific client situation, depending on maybe what job they have or what hobbies they're interested in. So really good opportunity to connect that. Now, what we're doing in that little story is, of course, we're not really focusing on any quantitative measure of value, but we're really looking for that emotional connection that is the benefit here. But it's actually important to remember that a lot of the added value comes through the mistakes that clients may not do and you prevent them from making. And to illustrate this, what Becca and I want to share now is a little example where we want to take you back to the beginning of 2020. So let's imagine it's the start of the pandemic. We probably all still remember that freshly in our minds. And there's a huge amount of stressful emotions during that period. And maybe some of you can remember some conversations you may have had with your clients during that time. Now, as we share this example with you, which is a great way to illustrate your value that you can bring to clients, especially during volatile and unpredictable times, I think, Becca, maybe you can share that story and I'll just sketch and illustrate some of it as we go along.
Sounds good, Sarah. So we're going to be using that example from investing in that really tumultuous and really anxiety-driven and emotional time of 2020. Because let's say as an investor, for example, you invested £1 million into that global equity market. So that MSCI All Country World Index, and you invested in it at the beginning of 2020. By the end of March, you would have lost, that's, within a few months, basically, you would have lost about 20% of your investment. So close to £214,000 due to the market decline. And I think we can all agree that would have been incredibly painful. So let's now imagine two different scenarios. Imagine with option A that you decide to redeem the remaining portfolio value to wait until markets have recovered and exit the market around the end of March. You now have to decide when is the right time to get back in. Maybe it's going to be June, maybe it's in July. But let's just say you decide to get back in at the time when the market recovers to the level before the crisis. And that happens to be actually the 5th of June. So you've decided to get back in to the time when the market has recovered to the level before the crisis. How much money would you now have at the end of the year? If we look at the growth in value of approximately £787,000 that you were left with after redeeming, that would now be close to £895,000 by the end of the year. But now let's look at another scenario, at scenario B. Imagine that instead of redeeming your portfolio investment at the end of March, you instead stay invested in the market. So you stay disciplined. You have a financial advisor and he's helped you through the emotions and has allowed you to stay disciplined and invested in the market. You might have lost a little bit more money, but you would have experienced the entire recovery. So if we look at how much your initial investment has now grown to at the end of the year, so the end of December 2020, we now see that 1 million to having grown to just over 1,100,000, so about 1.126 million. The difference between the value of your investment because you had a financial advisor, we can actually now quantify it. It was therefore close to £232,000. You may have similar stories and examples that you can sketch out. And we can also show this example in a graph format to help visualize this gap, this opportunity cost. And the initial difference will only grow larger over time as compounding does its work too. If clients ask whether it's worth having an advisor, as we can see in this particular story, especially after the last year we had with volatility, that financial advice is a big value add for investors. Well, we're coming to the end of our presentation now, so we're going to start concluding, because in conclusion, what have we actually learned from 2022, from 2020, and all of those other years where we've experienced volatility? Well, at Dimensional, we would argue that the same principles of a successful investment experience that we have been aligned to since our founding more than 40 years ago have proven to be more true than ever. In years when everything feels different and we find ourselves confronted with a new life and a new normal, it can be incredibly valuable to have a really sound investment philosophy that investors can stick to. And that is really the message here. A solid investment philosophy shouldn't just guide our decisions with regards to money in good times, but it should also be something investors can rely on in the bad times through all of those wobbles, so that we can have calm clients in volatile markets. What we're seeing on this slide is some of the points that we've mentioned today to really summarize what this investment philosophy is. So firstly, don't let your emotions control your investment decisions. Stick to that investment philosophy. Keep a long-term perspective. Harness the collective knowledge of all market participants. And importantly, a financial advisor can educate you on markets and help you find your peace of mind. Well, we hope you found this presentation useful and we look forward to your feedback. If you're interested in learning more about this topic or Dimensional, please feel free to reach out to us. Do we have some of the contact details here? No, it doesn't look like we have some of the contact details on this slide. But please feel free to reach out to us. I think that Gretchen will be able to provide you our contact details. For now, I'd like to say a really big thank you for your time and your attention. And as Gretchen mentioned earlier, it's really difficult for us to hear some of the questions over Zoom. So do, reach out to Gretchen or reach out to one of us and we'll be happy to answer any of your questions offline. We hope you have a wonderful day and thank you for your time again, and we'll pass it back over to you, Gretchen, now.
Just unmute myself. Sorry about that. I was too busy listening. Thanks so much. I think, I was scribbling away. I think that I can speak for a couple of people on the call that it doesn't matter, how many times you go through this, every single market volatility and everything that we've been going through seems particularly compounded, I think, in the last 3 years because of everything that we've been going through with the pandemic and personal worry and things like that. It just makes those heightened conversations with clients, and it's so important to think about different ways that you can express things. So I think it's what's particularly interesting is we know that every client and every person absorbs information differently. So some people are going to like charts and some people are going to like stories and some people are going to feel reassured by a story you can tell them that they can relate to in their other part of their life. So it was really really brilliant. Thank you so much. I know there's not a lot of people on the call, but I absolutely know that the recording is going to be of real value, so thank you so much. So we'll make sure that we can get that available to people as soon as possible. Just to round off then, as I mentioned earlier, I have set a WhatsApp group. I'm going to try and get a website sorted as well, and things will be changing slightly during the year. But the final, I guess, message is our next session is that it's in April. It's with Joanna Galdoin, who I've known for a few years. I've heard her speak before. She's talking about why solving work challenges starts with you. And she's really passionate about helping people understand how they can work in their work environment to overcome challenges and, harness support of other people. So that session is in April, and I'm just going to tell you the date. It's the 4th of April. Hopefully everyone's tax year end rush will be over by on the 4th because we won't be able to do much about it for the 5th. So hopefully we can get some people on that call as well. So thanks everyone for joining us, and thank you again to Rebecca and Sarah. I really appreciate it.
Thanks everyone. Bye-bye.
I'll end now. Thank you. Bye.
Thanks. Bye.